Implied volatility sounds complicated, but the idea is simple. Think of it like a weather forecast for a stock. The forecast does not say exactly what will happen, it just tells you how rough the conditions might get. Low IV means calm, quiet, small expected moves. High IV means turbulent, uncertain, big moves expected. That is all IV is, the market's way of saying how bumpy the ride might be.
Here is the most important thing to understand about IV. It does not tell you if a stock goes up or down. It only tells you how big the expected move is. A stock with high IV could go up 20%, or it could go down 20%. IV does not care which direction. It just says a big move is coming. This is why you can never trade based on IV alone. You still need a view on direction.
Think of options like insurance. When you insure a house in a calm neighborhood, the premium is cheap. When you insure a house in a hurricane zone, the premium is very expensive. Low IV is the calm neighborhood. Options are cheap. High IV is hurricane season. Options are expensive. The VIX shows the overall market version of this. Below 20, calm. Above 30, storm warning.
Here is the most practical thing about IV. Look at this. Same stock, same call option, same expiration date. Only IV changes. At 10% IV, the call costs $3. At 30% IV, it costs $10. At 60% IV, it costs $25. The stock never moved. Nothing else changed. Only IV changed. This is why you need to check IV before buying any option. You might be buying at $25 when the fair price.
There is one problem with just looking at raw IV. Is 30% IV high or low? For Apple, 30% might be extremely high. For a biotech stock, 30% might be very low. You need context. That is what IV Rank gives you. It compares today's IV to the past 52 weeks of that same stock. Below 30 means options are cheap for this stock. Above 50 means options are expensive. It is the one number that tells you instantly whether to be a buyer or seller.
Before any big announcement, nobody knows what will happen. Before earnings, before a Fed meeting, before any major event. That uncertainty causes traders to buy more options for protection. More buyers means higher prices, and higher option prices mean higher IV. This is called IV expansion. Watch the line climb on this chart. By the day before earnings, IV can be double what it was 2 weeks ago. Options get very expensive right before the announcement.
Now here is the dangerous part. The moment earnings are announced, all that uncertainty disappears and IV collapses fast, sometimes losing 50% of its value in a single day. Here is the brutal truth. You could buy a call option, the stock goes up, and you still lose money. Why? Because the IV dropped so fast that it wiped out your profit. This is called IV crush. It is the #1 way beginners lose money buying options before earnings.
Here is your simple rule to use from today. Before every options trade, check IV Rank. If IVR is below 30%, options are cheap. Think about buying calls or puts. If IVR is above 50%, options are expensive. Think about selling premium through covered calls or spreads. And before earnings, remember, IV crush is coming. If you want to trade earnings, wait until after the announcement when IV has already crushed and you can sell expensive premium. That is it. That is the whole framework. 5 seconds before any trade.